video, we're diving into whether gold is a smart investment for beginners. What's going on, everyone? My name is Eric Kunstlicher, and on this channel, we cut through the fluff to help you understand your options without being overwhelmed. With headlines about inflation, geopolitical tensions, and stock market volatility, it's natural to wonder if owning gold makes sense for you. We'll look at the history of gold, its benefits and drawbacks, and different ways to invest, and how to decide if you should have it in your portfolio. A brief history of gold. Gold as money. Gold has been used as a form of money for thousands of years. Ancient civilizations minted gold coins, and up until the 20th century, many countries operated on a gold standard, where paper money could be exchanged for a fixed amount of gold. This gave people confidence that their currency was backed by something tangible. In the 1970s, most countries moved away from the gold standard, allowing their currencies to float freely. Since then, gold has traded like any other commodity, with its price driven by supply and demand. Gold during crises. Throughout history, gold has been a refuge in a time of crisis. When governments fall, currencies collapse, or economies contract, gold often retains value. For example, during the Great Depression, gold prices rose as stock markets crashed. In the 1970s, gold surged amid high inflation and geopolitical turmoil. During the 2008 financial crisis and the early months of the COVID-19 pandemic, gold prices spiked as investors sought safe havens. These episodes have reinforced the idea that gold is a store of value during turbulent times. Long-term trends. Now, over the long term, gold's price has generally trended upward, albeit with long stretches of stagnation or decline. If you zoom out over decades, gold has preserved purchasing power. For instance, a coin that could buy a fine suit 100 years ago can still buy a fine suit today. However, if you bought gold at certain peaks, like in 1980 or 2011, you might have waited years to see positive returns. Understanding that gold is subject to cycles helps set realistic expectations. The benefit of gold diversification. One of the primary reasons to invest in gold is diversification. Gold tends to move independently of stocks and bonds. When equities experience steep declines, gold may hold steady or rise because investors flock to safer assets. By holding a small amount of gold, you can reduce the overall volatility of your portfolio. This doesn't mean gold will always protect you, but it can act as a counterweight during market stress. Inflation hedge. Gold is often touted as an inflation hedge. When the price of goods and services rises, the value of paper money declines, but gold has historically maintained its purchasing power over long periods. If inflation accelerates because of supply chain issues, massive government spending, or other factors, gold may benefit as people look for assets that aren't tied to any currency. That said, gold isn't a perfect hedge. There have been times when inflation rose and gold didn't perform as expected. Still, over many decades, gold has tended to outpace inflation. Safe haven in geopolitical uncertainty. Geopolitical events like wars, trade disputes, or political instability can unsettle financial markets. When these events occur, investors often seek safe haven assets like gold. Gold's value isn't dependent on corporate earnings or government fiscal policies, so it can hold up when those are in question. Owning gold can provide psychological comfort during uncertain times, knowing that part of your portfolio isn't tied to the fate of any single economy or political system. The drawbacks of gold. Lack of income. So gold doesn't pay dividends or interest. When you invest in stocks or bonds, you may receive dividends or coupon payments that contribute to your return. With gold, your only hope for profit is that the price goes up. If gold's price stagnates for years, you earn nothing. This opportunity cost is significant, especially for long-term investors who need growth to fund retirement or other goals. Price volatility. Though gold is considered a safe haven, it can be volatile. Its price is influenced by many factors: interest rates, currency movements, central bank policies, and investor sentiment. Gold can experience rapid price swings over short periods. After hitting a high in 2011, gold dropped significantly over the next several years. If you buy at a peak and you need to sell shortly thereafter, you could face losses. Understanding this volatility helps temper expectations and underscores the need for a long-term perspective. Storage and insurance costs. If you buy physical gold, you'll need a safe place to store it and insurance to protect against theft or damage. Whether you choose a home safe, a bank deposit box, or a third-party vault, storage costs can add up. If you buy gold through ETFs or mutual funds, you avoid storage hassles but incur management fees. While these costs are lower than storing physical metal, they still reduce your net return. Ways to invest in gold. Physical gold. Buying physical gold, like bars, coins, or rounds, gives you direct ownership of the metal. You can hold it outside the financial system, which appeals to those who fear systemic risk. However, you must arrange secure storage and pay for insurance. Physical gold is best for those who want tangible assets they can control. Popular coins include American Eagles, Canadian Maple Leafs, and South African Krugerrands. Bars often come with lower premiums over the spot price, but may be less liquid when selling. Gold ETFs and mutual funds. Exchange-traded funds like SPDR Gold Shares, GLD, hold physical gold and issue shares that trade on stock exchanges. These funds allow you to gain exposure to gold's price without dealing with storage. Management fees are typically low, but you do take on some counterparty risk and tracking error. Mutual funds that invest in gold mining companies provide indirect exposure and can offer higher returns if the company performs well. However, they carry stock market risk in addition to gold price risk. Gold IRAs. Gold IRAs let you hold physical gold within a retirement account. So companies like Augusta Precious Metals help set up the self-directed IRAs. While the tax advantage of IRAs apply, gold IRAs come with higher fees and storage requirements. These accounts are best for investors with significant portfolios who want to allocate a portion to physical gold while maintaining a tax advantage structure. Now, be aware of the costs and rules associated with these accounts before proceeding. Other vehicles. You can also gain gold exposure through futures contracts, options, or mining stocks. These instruments can amplify gains, but they come with added complexity and risk. They're generally not recommended for beginners without experience in derivatives or individual stock analysis. If you're just starting out, focus on simpler methods like physical gold, ETFs, or gold-focused mutual funds. How much gold should you hold? Portfolio allocation. Financial advisors often suggest keeping about 5 to 10% of your portfolio in precious metals, including gold. This allocation provides diversification benefits without sacrificing too much growth potential from stocks and bonds. If you're highly concerned about inflation or systemic risk, you might tilt slightly higher, but be cautious not to allocate too much. A larger gold position can drag down returns when other assets outperform, adjusting over time. Your allocation to gold may change as your goals and circumstances evolve. Younger investors may prioritize stocks for growth and hold less gold. As you approach retirement, you may increase gold slightly to reduce volatility. Rebalancing annually ensures that gold doesn't drift far from your target. If gold prices spike relative to stocks, selling some gold and buying more stocks keeps your portfolio aligned with your plan. Personal comfort and education. Ultimately, the right amount of gold depends on your comfort level and understanding. Holding gold helps you sleep better at night. That peace of mind is valuable. But base your decision on facts, not fear. Educate yourself on how gold works and its role in the global economy. Consult with a financial advisor if you're unsure how to integrate gold into your overall strategy. Getting started. Research and planning. Start by assessing your overall financial situation. Ensure you have an emergency fund and you're contributing to tax-advantaged retirement accounts. Then decide how much of your savings you want to allocate to gold. Research different ways to buy gold. Physical, ETFs, IRAs, and choose the method that aligns with your preferences and budget. Check reviews of dealers and brokers. Compare fees and understand all the costs involved. Small steps. You don't need to commit a large sum right away. Consider making a small initial purchase to become familiar with the process. Many dealers offer fractional gold coins or bars, or you can buy a few shares of a gold ETF. Keep notes on the cost, premiums, and any fees so you can compare your experience across dealers or platforms. As you become more comfortable, you can gradually increase your position. Ongoing education. Gold isn't a set it and forget it investment. Stay informed about economic trends, monetary policy, and geopolitical events. Understanding the factors that influence gold prices helps you avoid emotional decisions. Subscribe to newsletters or follow reputable analysts. But remember that no one can predict gold prices with certainty. Focus on fundamentals and long-term trends rather than short-term noise. Starting small and building confidence. If you've never invested in gold before, there's nothing wrong with starting small. You can buy a single coin or a small bar to get comfortable. This allows you to learn how pricing works, how to store your metal, and how it feels to own something physical. Over time, as your confidence grows, you can adjust your holdings. Investing isn't about making a huge bet all at once. It's about building habits and knowledge. So by beginning with a manageable account, you reduce the risk of making costly mistakes and you gain experience that will serve you well in future decisions. So gold can be a smart investment if you understand its role, benefits, and limitations. It offers diversification, a potential hedge against inflation, and a safe haven during geopolitical turmoil. However, it also comes with price volatility, lack of income, and storage or management costs. Beginners should approach gold as part of a balanced portfolio, allocating a modest percentage and choosing investment vehicles that suit their needs. By educating yourself and keeping your emotions in check, you can decide if gold deserves a place in your financial plan. So, if you want to try out any of the tools or resources we mentioned today, like Augusta Precious Metals for a gold IRA, you'll find everything linked in the description below. Now, some of the links down there are affiliate links, which means we earn a small commission if you decide to use them at absolutely no extra cost to you. Really helps support the channel, and it lets us keep making simple, beginner-friendly videos just like this to help you take control of your money. So if you use them, we thank you so much in advance. And if this video helped you out, don't forget to like, subscribe, and hit that notification bell so you never miss a new video. Here on Your Money Friend, we talk about saving, banking, investing basics, and all the little money decisions that make life easier without the confusing jargon. So thanks for watching, and I'll see you in the next video.